Okay. Well, for those of the attendees who are joining us, this is our webinar with myself and Vivek Bansal, and we're going to wait a minute or so, wait till people get going before we get going with the presentation, okay? So just give us a moment, grab a quick coffee if you like, and then we'll get going very, very shortly. So by the way, for the participants, just wanted to remind everyone, during the presentation, if you have a question, you go down the bottom and there's a Q&A box there. Fill in your question. Now, we're not going to deal with them during the presentation. We're going to deal with them at the end. We're going to have probably a good 10 minutes for questions at the end, but feel free during any part of the presentation. If something comes up, Vivek says something and that spurs on a question, write it down right away, and we'll do our best to get to it at the end of the show. So I see people are filling up. That's great. Maybe another 30 seconds or so, and then we'll get going with the show. Okay, I've already got my coffee here. Okay. Okay. All right, what do you think? Should we get going now, everyone? All right, why don't we do that then? So, welcome everyone. This is our first webinar of the new year. My name is Paul Barreca, Certified Financial Planner and Wealth Advisor at West End Wealth Planning, IPC Securities Corporation, and I'm here of the pleasure to be joined by Vivek Bansal, who is the director. He's the other fellow on the screen, who's the Director of Tax and Estate Planning at Mackenzie Investments. And what else? You have a whole bunch of designations. We won't bother going into them. So again, Vivek, I think we had a great program today. And by the way, I want to let everyone know that this presentation will be available on a replay. Everyone who registered, they're going to be sent an email a day or two after, and there'll be a link on there if you want to watch this again. Often people they missed a point or two and they want to go back, or if you want to send the link to friends, colleagues, family members who might be interested in this very timely information. So we got a number of topics we want to go over today. One of the initial ones that we get a lot of comments on is when to take Canada Pension Plan and Old Age Security. We're going to talk about income splitting strategies. We're going to talk about how to integrate your tax-free savings account into your retirement savings. And this is really, really important. We're also going to talk about the order you make your retirement planning withdrawals. This can have a huge impact on your eventual net after-tax estate. We're going to talk about layering income. And at the end of it, Vivek has got a very interesting hypothetical case study of two couples hypothetical couples who own a business. So they have potential income from various sources, including passive income within a corporation. He's going to run through a number of 3 different strategies, I believe. And he's going to show you the impact that each strategy in this particular situation would have on an after-tax estate and income. So why did I choose this topic today anyway? Well, it's not news to anyone. The Canadians, we pay a lot in taxes. Matter of fact, according to the latest Fraser Institute study, in 2023, the average Canadian family earned $106,430 and paid an average of $48,199 in taxes. That's taxes in all forms, income tax, HST, liquor tax, gas tax, everything. So that's about a little over 45% of your income. By the way, that's much more than the average family pays for shelter, clothing, and what's the other, and food combined, which is about 35%. And by the way, I don't know about each of the participants here, but governments have huge and growing debts, every level of government. I don't know anyone who thinks that taxes are actually going to go down. Matter of fact, I think taxes are going to go up, and they're going to do it in kind of sneaky ways, if you ask me. They're going to claw a little bit here, a little bit there, so we don't notice it. But it's certainly going to happen. Governments need our money. So that brings up the aspect of why we're here today, to talk about taxes and your retirement income, how you want to give less to those people in Ottawa, to those people in Queen's Park, and so forth. So with that being said, let's see now. Oh, by the way, just one last thing before we get to Vivek. I've been in this business for 32 years. And one of the things I found, I did over 20 years doing radio and CFRB and 640, and I saw over 1,000 people who come to me for help. And one of the things I really noticed was that a good chunk of those people were missing something in the retirement planning, missing something that would cost them money, missing something they could often prevent with some planning. So hopefully what we're going to do is spur each and every one of you to get planning today, to not be one of those people who came to visit me and said, oh, geez, I should have done this 10 or 15 years ago. So listen to the presentation today. We're going to start with, I'm going to hand the reins over to Vivek, and he's going to put a presentation deck up on the screen. And again, Vivek, we're going to start with the first topic, right, is when to take your Canada pension plan and old age security. Boy, I get this all the time. And it can't, depending on the circumstances, right, it can be simple or it can be quite complex. So why don't I hand it over to Vivek for this one, and let's get the show rolling. Let's get the show rolling.
Perfect. Thank you, Paul. Good afternoon, everyone. Let me share my screen here so you can follow along. Okay, so we've already gone through the topics. So these are the topics we're covering, which Paul already talked about. So starting with CPP and OAS benefits and how you can determine when is the best time to start receiving these benefits. So as an overview, the traditional age of taking CPP and OAS is age 65. CPP can begin as early as age 60, but if you do take it prior to age 65, your benefits would be reduced. So the reduction could be as much as 36% if you're taking CPP at age 60, compared to what you would have otherwise received if you waited till age 65. And the opposite is also true. If you choose to delay CPP past age 65, you would benefit from a premium in your benefits, and that premium can be up to 42% if you're delaying your CPP all the way to age 70. If we talk about OAS or old age security, there's no provision to take it prior to age 65, so the earliest you can take it is age 65, but you also have the option of delaying it past age 65 to again receive a premium, which could be as much as 36% if you're delaying OAS to age 70. Now, if we talk about the amount of benefits you could receive under CPP, those would directly be tied to the amount of contributions you made to the Canada Pension Plan during your working years. For OAS, it does not require any contributions. The amount of OAS benefits you would receive is typically tied to the number of years you've been a resident of Canada. Now, to receive the maximum OAS, generally speaking, you must have resided in Canada for at least 40 years after turning 18. Both CPP and OAS require an application with Service Canada. Sometimes the government may auto-enroll you for OAS benefits, in which case you would typically receive a letter after your 64th birthday stating that you've been auto-enrolled in OAS benefits. But if you don't get that letter, it would be important for you to make sure that you're applying with Service Canada to make sure these benefits begin by your desired age. So as you see, when you decide to take CPP and OAS will impact the amount of benefits you receive, because there could be a reduction or a premium that you receive in these benefits. So when is the right age to take these benefits? Well, there's no one age that would work for all individuals. It really depends on your specific circumstances. But in the next few slides, I'll talk about various factors that can help you make that decision. So the first factor I'll talk about is looking at your life expectancy. Now, we know that no one has a crystal ball to predict how long they will live to, but usually an approximation can be made based on your health condition and how long your family members have lived to, such as your parents and your siblings. So the general rule of thumb here is if you're expecting a longer lifespan, then you may want to delay CPP and OAS as much as possible so you're collecting the premium payments for a longer time period during your lifetime. So that would allow you to collect more benefits from the government during your lifetime. And the opposite is also true. If you're expecting a shorter lifespan, then you may want to take CPP and OAS as early as possible so that you would end up collecting more total benefits over your lifetime. Now, the same concept can also be illustrated using a break-even analysis. So break-even analysis allows us to compare two different start ages. Let's call it the earlier age and the later age for taking these benefits, whether it could be CPP benefits or OAS benefits. So it allows us to compare the two different ages to figure out the break-even point, which is the age if you expect to live past that break-even age, you'd be better off taking these benefits starting at the later age as opposed to the earlier age. So I'll use an example to illustrate how these break-even ages work. So the table that you see at the bottom of this slide summarizes our analysis for the CPP break-even age between ages 60 and 65. So if we use a simple example, let's say you expect to receive the maximum CPP benefit at age 65 using 2024 amounts, that would be $1,365 per month. And you're considering whether you should take CPP at age 60 versus 65. Well, we know that if you take it at age 60, your benefits would be reduced by 36%. So that comes out to roughly $873 per month. And what you see in this table, the break-even age is 73.9 years, or let's round it up to roughly 74 years. So what that means is if you expect to live past age 74, you may be better off to start CPP at age 65 versus age 60 because you would end up collecting more total benefits over your lifetime.
You know, Vivek, if I'm going to interject here, I find it not uncommon where people take the CPP earlier than they should. And I think because they don't realize how much it could cost them down the road, I think some people just say, I want the money now. I've paid into this for so long. I want the money now. They don't totally realize that this could cost them a lot of money in the long run.
Mm-hmm. That's a really good point. So if we use the same example to look at it in a graph format, this again ties to the point that Paul made, is so what you see in this graph is the blue line represents the total CPP benefits you would receive if you start taking CPP at age 60, and this graph is showing the total amount to age 100. The orange line represents the total CPP benefits you would receive during your lifetime to age 100 if you start taking CPP at age 65. The intersection of these two lines is, as you see, roughly age 74, and that's the break-even age I talked about on the previous slide. So what you notice on this graph is after age 74, the orange line is always higher than the blue line, which means once you live past age 74, you would always end up receiving more total benefits over your lifetime if you start your CPP at age 65 as opposed to age 60. So that's essentially what you could lose in terms of total benefits received if you take your CPP earlier rather than at age 65. So that's one factor for you to consider.
By the way, again, Vivek, one of the things that I found in my practice is that what we hear, a lot of people say, oh, I'm not going to live that long. But you know what? I think people are not looking at the numbers. People in general are going to last longer than how long they feel or how long they think they will. And again, like you said, you want to base it on, what's the family history? Did your parents pass away early? Did they live a long life? What about your siblings? Look at all those types of factors and look at your need for the money and decide whether to take it earlier or later.
That's a good point. So the second factor, what you see on this slide is looking at, as Paul just mentioned, whether you need that additional income or whether you have the option of taking it earlier and potentially investing those benefits to earn a rate of return, which could also impact the break-even age. So if you need that extra income to support your retirement expenses, then there's not much flexibility in terms of when you should start taking these benefits. But if you have the option of taking it earlier and investing it, that could swing the decision in favor of taking it earlier. So we analyzed the impact of different rates of return on the CPP break-even age. So we're still looking at the same example on the slide where you're comparing taking CPP at age 60 versus 65. And but you don't need the cash until age 65. So you have the option of taking it earlier at age 60 and investing it to earn a rate of return. And so that would also increase your break-even age. So that could swing the decision in favor of taking these benefits earlier in certain situations. So to use a couple of examples from this table, which is a summary of our analysis for CPP break-even using different rates of return. If we look at 3% rate of return, the break-even age moves from 73.9 years, which was the case when there was no rate of return. Now it's 76.3 years. If you look at 6%, it moves higher to 81.2 years. So what we noticed with this analysis is as the rate of return increase past 6%, so once they start to approach, let's say 9%, the break-even age started to exceed 140 years. So if you're in that situation where you could potentially take these benefits earlier, but you don't...
Excuse me, I think you meant 140 months.
No, 140 years.
140 years.
If we're approaching 9% rate after-tax rate of return.
Oh, I see.
So our analysis showed that the break-even age was closer to 140 years. So what that means is if you have, let's say, have the option of taking these benefits earlier at age 60 and perhaps invest these benefits in your TFSAs because you have the contribution room available, and you can earn 8 or 9, you think you can earn 8 or 9% return on that investment, you may prefer to take it earlier because the break-even age is really high and you may be better off to earn a higher rate of return as compared to the premium you would otherwise receive by starting your benefits at a later age.
Right.
So other factors for you to consider include looking at the impact on any income-sensitive benefits that you may be receiving. For example, OAS benefits are subject to a clawback if your net income exceeds a certain threshold. So earlier in your retirement, if you're in a situation where your net income is higher and approaching this clawback threshold, you may want to delay CPP and OAS to a future year when your other income sources are lower, so you get to keep more of your OAS benefits. The last factor I'll talk about on this slide is looking at current versus future tax rates. Generally, individuals are maybe in a high tax bracket earlier in retirement because they have many different sources of income that pushes them into a higher tax bracket. So if that applies to your situation as well, you may consider delaying CPP and OAS to a future year when your tax brackets are lower, so you get to keep more after-tax dollars from these benefits to spend in your retirement.
Vivek, it was interesting, your concept there of taking the money early and investing it. Of course, the pros and cons of that are that if you invest the money and you think you're going to get 9%, that's by no means guaranteed. Mm-hmm. And so it depends on you as the individual. Is that guarantee important? And I find in retirement, a lot of people, the guarantees are important. Here you have a source of guaranteed inflation protected income that makes a lot of people feel very, very comfortable. Before we go on to the next topic, which is income splitting, a fun topic, I want to remind everyone that go to the bottom of your screen. There's a Q&A section there. And if you have questions, put the questions in there. We're not going to deal with them during the presentation. We're going to deal with them in. We're going to have probably 10 minutes at the end of the program to deal with questions and answers. By all means, go there, type them in. We'll do our very, very best to get to them. So as you can see on the screen, the next topic is income splitting. And we're going to talk about CPP and old age security, pension and income splitting, spousal RSPs, TFSAs, and something called prescribed rate loans. So Vivek, I'm going to hand it back over to you, and you can go through this for us.
Awesome. Thank you. Thank you for those points. And so what we're focusing on here is income splitting strategies for spouses in retirement. So it's the idea of moving funds or moving income from the higher income spouse into the hands of the lower income spouse to take advantage of their lower tax brackets. So whenever you're using an income splitting strategy, it's always important to be careful about the income attribution rules, which could essentially deny that income being split and still tax it in the hands of the higher income spouse. But what we'll talk about are strategies that are not subject to income attribution rules. So the first strategy is looking at CPP pension sharing. So this could be beneficial if you're in a situation where the higher income spouse is expecting to receive a much larger CPP benefit compared to the lower income spouse. So instead of having those benefits taxed at high tax rates, you could apply it to Service Canada in writing to have your CPP pension shared among yourselves as spouses or common law partners. So in that situation, the CPP benefits would be distributed among the spouses, so not all of it would be taxed at the high tax bracket for the higher income individual. So this strategy is available where both spouses are at least age 60, and this only requires a one-time application with Service Canada. Once Service Canada approves the pension sharing, they would continue to share the pension income each year until certain events occur, such as one of the spouse passes away, or the spouses separate, or there's a divorce between the couple. The second strategy for you to consider is pension income splitting. So this is available if you have eligible pension income. You can file an annual election with your tax return. So talk to your tax accountant about making that election. If you're receiving eligible pension income, you can split up to 50% of eligible pension income and have it taxed in the hands of the lower income spouse or partner. So what is considered eligible pension income? It will include income from employer-sponsored pension plans. That could be split at any age. Otherwise, if you're 65 and above, it would also include income from your RRIF account, income from locked-in RRIF accounts or LIF accounts, and certain lifetime annuity payments can also be split under this strategy. The third strategy is considering maximizing the use of spousal RSPs. So the idea here is the higher income spouse makes a contribution into the lower income spouse's RSP so that by the time both spouses retire, their RSPs would have a similar balance, so that retirement income from these accounts, which may primarily be in the form of RRIF income, is not being taxed in one spouse's hands, so it's more evenly split among the spouses to take advantage of lower tax rates. So you may be wondering, why can't we simply achieve essentially that same objective using pension income splitting, where we could split RRIF income after age 65? Well, you have to keep in mind that pension income splitting is limited to 50% of income splitting. So with spousal RSPs, you could potentially split up to 100% of that income. So to use a simple example, let's say you contribute $1,000 to your own RSP. Once you turn 65, you take that $1,000 as RRIF income. You can have up to $500 of that taxable to your lower income spouse or partner. On the other hand, if you make that same $1,000 contribution to your spouse's RSP, who is expecting to be in a much lower tax bracket during retirement, now that same $1,000 100% of that $1,000 could be taxable to them alone. So you're not limited to only being able to split 50% of that $1,000. So it could result in additional tax savings in certain situations. The fourth strategy to consider is maximizing the use of TFSAs. As you would be aware, TFSAs are great savings accounts to benefit from tax-free growth and flexibility in withdrawals without impacting your taxes or net income for the year. From an income splitting strategy perspective, if you're in a situation where the lower income spouse is not able to top up their TFSAs each year because they don't have enough income, the higher income spouse could consider gifting cash to the lower income spouse to allow them to top up their TFSAs, and that gifting or any income earned from that gifted money that is contributed to the TFSA would not be subject to income attribution rules. The last strategy that you see on this slide is a prescribed rate spousal loan. So this would apply to your non-registered investments. As I mentioned earlier, due to income attribution rules, the higher income spouse cannot simply gift cash or investments to the lower income spouse and have them earn that income in their own non-registered account, because that income would be typically attributed back to the giftor or the higher income spouse. So to get around these income attribution rules, prescribed rate spousal loan can be utilized. This strategy does have specific requirements. For example, this loan must have an interest attached to it, which must at least equal CRA's current prescribed rate, which currently is at historically high levels of 6%. So this strategy may not be very beneficial from a tax perspective under the current interest rate environment, but that's something definitely you can consider as interest rates starts to decrease in the future.
I know, Vivek, we had a couple of years ago, the prescribed rate was 1%. We were actively promoting this strategy for the right clients to say, hey, because once you lock into that prescribed rate, you're locked into that for life. If interest rates go up after that, it doesn't matter, right?
Correct.
You're locked in. The people that were fortunate enough to lock into that 1% prescribed rate, boy, they got a deal for the length, the total length that loan is in place. So good strategy. Okay, I think we're, oh, by the way, I want to remind everyone that again, if you have a question, we're going to get to questions at the end of the presentation. We're going to have probably about 10 minutes, hopefully, to deal with these things. And go to the Q&A box at the bottom. We're accumulating some questions there already. We will do our very best to get to them at the end of the presentation. Please put them there. And the next strategy, well, now we're going to talk about tax strategies for converting RRSPs to RRIFs. And again, this is something that comes up not uncommonly in our practice, but I'm going to hand it over to Vivek, and he's going to go through the various items here.
Sure, thank you. So once you turn 71, by December 31st of that year, you would have to close down your RRSP, because from tax rules perspective, you cannot keep your RRSP open after the year you turn 71. So most individuals would typically convert it to a RRIF account on a tax deferred basis. And what that means is once you have a RRIF set up, the year following, you have to start taking minimum RRIF payments. So one strategy for you to consider is basing those minimum RRIF payments on the age of a younger spouse or partner, if you have a younger spouse or partner. So that would allow you to reduce the minimum payments you're taking from your RRIF account, so you're still benefiting from the tax deferred growth with the remainder of the funds within this RRIF account. The second strategy, which we already talked about earlier, is using pension and income splitting with RRIF income once you're 65 or above. That can allow you to take advantage of the lower income spouse's tax rates. The third strategy is making sure you update your beneficiary designations when you're converting your RRSPs to RRIFs, because even though you had beneficiaries designated for your RRSPs, those would not automatically roll over to your RRIF account. So it's important for you to make sure you talk to Paul about making sure your beneficiaries designations are updated. The fourth strategy that you see on this slide is considering making a final RRSP contribution in the year you turn 71. So if you're in a situation where, let's say you will have earned income in the year you turn 71, so that will only generate RRSP contribution room the following year, but in that year you can no longer keep your RRSP account open, so you cannot make a contribution to your own RRSP. In that case, you could consider making a spousal RRSP contribution if you have a younger spouse or partner that is below age 71. Or if that doesn't apply to you, you could consider making a final RRSP contribution in December of the year you turn 71. So even though that would be considered an over contribution subject to penalties, typically the tax savings would far outweigh the penalties, so it could still be beneficial from a tax perspective. So let me use a simple example to illustrate this strategy. So let's say Thomas will be turning 71 in 2024. He is self-employed, so he's expecting to have earned income of $150,000 this year. That means Thomas will have an RSP contribution room of $27,000 in 2025. So we're going to assume that Thomas does not have a younger spouse or partner. So the concern here is Thomas would not be able to utilize that RSP contribution room in 2025 because he can no longer keep his RSP account open after December 31st of this year. So one potential solution for Thomas to consider is using his 2025 RSP contribution room in December of 2024. So this would mean that he contributes the $27,000 into his RSP in December of 2024, and any over-contribution above $2,000 would be subject to a penalty of 1% per month. So for Thomas, for the month of December, his penalty would be $250. So this over-contribution would disappear on January 1st, 2025, because that's when the new contribution room kicks in. And Thomas would be able to deduct the contribution against his 2025 taxable income. So assuming he's in the same tax bracket in 2025, that could provide him savings in excess of $11,000. So tax savings in excess of $11,000 in 2025. So as you see, the penalty that applies is much lower than the potential tax savings, and it would also allow Thomas to set aside additional dollars for his retirement. So that could be another strategy that you may want to further explore with Paul and your tax advisor to determine if it would be suitable for your specific situation.
I'd like to go back, actually, if I can, Vivek, and talk about TFSAs again, and something that might be missed a lot of times before we go on to the next topic, and that is you generally do not want to designate a beneficiary for your TFSA. Let's say there's two spouses. They designate each of them to be a beneficiary on the TFSA. One passes away, that money now would go tax-free to the surviving spouse. But now all of that money is going to be put into a taxable situation unless the surviving spouse has TFSA room available. A better way of doing it is designate your spouse as successor annuitant. And the big difference there is now all the money from your tax-free savings account upon your demise can roll tax-free into your spouse's tax-free savings account, and it can continue to grow tax deferred. Very important strategy that I'm not sure if everyone gets. We make sure everyone in our practice has that done for them. Again, want to mention also Q&A at the bottom near the left-hand side. You're going to have a Q&A box there. By all means, if you have questions, please put them in there. We're going to have a period at the end where we're going to answer as many of those questions as we can get to. Okay, now the next, we got is TFSAs in retirement. That's the next topic. Okay, fire away, Vivek.
Yeah, perfect. Yeah, so talking about TFSA a little bit more, we touched on it earlier, and Paul mentioned a really good point, which touches on the point number 4 that you see on this slide as well. But just to wrap up TFSAs, so these can be great savings vehicle to earn tax-free growth and provide flexibility in withdrawals during retirement, because any withdrawals would not impact your taxes or your income for the year. So they would not impact any income tested benefits or tax credits that you may be receiving. So TFSAs can also be used to redirect any excess cash flow that you may have during retirement, which could be from OAS and CPP benefits that you're receiving, or minimum RRIF payments that have to begin after age 71. If you don't necessarily need that income, you could look to reinvest it in your TFSAs and benefit from tax-free growth. The last point here, TFSAs can be very beneficial from an estate perspective. That's a strategy that Paul just touched on. So making sure if your goal is to leave your TFSA for your spouse or partner, consider naming them as a successor holder as opposed to simply naming them as a beneficiary. So I won't go into detail on that again because Paul explained it very well.
Okay. The next topic we're going to talk about is the order of asset withdrawal. And boy, we've done a number of analysis on retirement for our clients. And when you take out certain assets can have a very significant impact, especially on the after-tax estate. We had one particular situation where changing whether the income came up from registered or non-registered made a $2 million after-tax difference in the estate. This is not small change here. So again, great topic here. Vivek, I'm going to hand it over to you now.
Awesome. Thank you, Paul. So just to provide a little bit more background, what we mean by order of asset withdrawal is, let's say, once you approach retirement, you have significant savings in your non-registered account, your RRSPs or your RRIFs, and your TFSAs. So the question that you would likely have is, where should you draw income from first? Should it always be your non-registered account first? Or should it always be your RRSPs or your RRIFs first? Or should it be your TFSAs first? As you may have guessed, there's no one solution that would fit everyone's situation. But I'll talk about 3 factors over the next few slides that can help you make that decision in terms of what may be optimal order of asset withdrawal for your specific circumstances. So the first factor to consider is looking at the tax credits and income tested benefits that you may qualify for in retirement. Some of those tax credits and income tested benefits may be clawed back above a certain income threshold. For example, if you're receiving the age amount tax credit, which is available to Canadians age 65 and above, this tax credit would be clawed back where your net income exceeds a certain threshold. So order of asset withdrawal can be used to make sure your net income does not exceed that threshold or is as low as possible so that you could maximize this tax credit. And that could be, for example, instead of taking additional RSP withdrawals, you could take additional TFSA withdrawals in a given year. So you still get that cash to spend in retirement, but it would not increase your net income in the year. One more example I want to use from this slide is pension income amount, which is also a tax credit available on the first $2,000 of eligible pension income. If you're in a situation where you don't have income from an employer-sponsored pension plan, and you're at least age 65 or above, you could use order of asset withdrawal to create eligible pension income by converting a portion of your RSP into a RRIF account, because then RRIF income would count as eligible pension income. And then that can allow you to take advantage of this tax credit in retirement as well. The second factor to consider is the concept of layering income. So what we mean by that is, if you're in a high taxable income year, so because of your specific situation, there was capital gains or other forms of income that you earned in the year that pushed you into the higher tax bracket. If that's your situation in a given year in retirement, you may consider in that year taking income from more tax efficient sources first, so you're not paying taxes on that additional income at the highest tax bracket, which in Ontario would be 53.5% approximately. So if you're in a high taxable income, high tax bracket in a given year, you could take additional income from your TFSAs, because those would not be taxable, still provides you cash flow that you could spend in that year without being taxed at 53.5%. If you're owner of a private corporation and there's a balance in the private corporation's capital dividend account, you could consider issuing a tax-free capital dividend from your private corporation. Again, that would provide you the cash flow without increasing your net income for the year. So you're not paying taxes at high tax rates. Similarly, if you loaned money in the past to your private corporation, that could be repaid to you on a tax-free basis and can provide you additional funds in those years. And the opposite is also true. If you're in a low tax bracket year, if you have low taxable income in a given year, so you're in a low tax bracket, in those years, you could consider maximizing the use of less tax efficient sources of income first. So that could be taking additional RRIF withdrawals or RSP withdrawals, or taking additional non-eligible dividends from your corporation in that year. Because even though these income sources would be taxed, so RRIF income and RSP would be 100% taxable, you're only paying taxes at much lower tax rates. So it could allow you to keep your average tax rates throughout retirement lower and smooth out your average taxes throughout your retirement. So you're not paying too much taxes in one year and almost nothing in another year.
Okay, now we're getting near the end. We have our RSP and RRIF exit plan, and then we're going to go after this to our case study. Now, I want to remind people again, the Q&A box is at the bottom of your screen. We're going to do our best to get to those after the presentation. And you know what, Vivek, one of the things while I'm listening to you go over all this great information is that this really emphasizes the needs to plan and plan early. It's not uncommon. I hear people, maybe they're in their mid 50s and they'll say things like, oh, I don't need to plan. I'm not retiring for 10 years. Then 10 years down the road, they're about to retire and they go, oh, geez, I should have done this 10, 15 years ago. Now it's too late. I have money in the wrong places. And to switch it around is going to cost a lot of taxes. The key to this is strategizing and planning as early as you possibly can to get it right. Okay, Vivek, let's go. RSP RRIF exit plan.
Awesome. Yeah. So with RSPs and RRIFs, the traditional approach has always been to defer withdrawals as much as possible. But you also have to keep in mind, especially when you're determining your order of asset withdrawals in retirement, that once you pass away, 100% of the balance in your RSP and your RRIF account would typically be considered taxable income. So let's say if you have $500,000 in your RSP when you pass away, or your RRIF account, that could mean you may end up paying, or your estate may end up paying close to $250,000 to the government in taxes. So better strategy for you may be to instead systematically and strategically draw down your RSP or your RRIF account during your retirement, so including a portion of your portion of the income from these accounts in your tax return each year and paying taxes at much lower tax brackets. So these withdrawals could be used to fund your retirement income needs. But if you don't need that additional income, you could look to redirect it and invest it more tax efficiently. For example, invest it in your TFSAs to earn tax-free growth, or invest it in your non-registered account to earn tax-efficient growth in the form of capital gains or eligible dividends by investing in Canadian public corporations or investments that pay Canadian public dividends. Another strategy for you to keep in mind with RSPs and RRIFs is you can designate a qualifying survivor as the beneficiary on these accounts. So that could be your spouse or partner, your financially dependent minor child or grandchild, or your child or grandchild of any age that is financially dependent on you because of a disability. So when one of these individuals are named as a beneficiary on your RSP or your RRIF account, 100% of the balance does not immediately become taxable when you pass away. Rather, it would be taxed in the hands of the beneficiary when they receive that income in the future. So at that time, they could be subject to a much lower tax rate. So it could also allow you to keep more of those funds for your beneficiaries rather than paying a large amount of tax on these savings.
So now we're at, now I'm sorry, because this is my favorite part of the whole presentation. I think that kind of brings everything together. Vivek has prepared a very interesting case study here that talks about a couple, Tom and Gina. And the interesting thing about them, they have a number of sources of income, including potential income from passive income from their corporation. So again, Vivek, I'm going to pass this over to you and let's go through this. I think this may be the most interesting part for many of us here.
Perfect. Thank you, Paul. So this case study would illustrate the importance of order of asset withdrawal. So we're looking at Tom and Gina, who are owners of a private corporation called TG Inc. Tom was always actively involved with the corporation, and Gina was only added as a shareholder for income splitting purposes. This was prior to the rule changes in 2018. But Tom and Gina are now both retired. Tom is 65, Gina is 63. And they're looking to maximize their retirement income in a tax-efficient manner. So we're going to assume they're residents of Ontario. Gina has a defined benefit pension plan from her employer, Tom is currently receiving CPP and OAS. Gina will also start collecting at age 65. And they plan to downsize their home in about 5 years, which will give them an additional $500,000 that they would use towards their retirement as well. So based on their retirement lifestyle, they expect they would need $120,000 each year in retirement after taxes. So they want to spend $120,000 each year. This is a quick snapshot of their current investments or their savings for retirement. So both Tom and Gina have RRSP accounts, some money in their RRSPs. They each have TFSAs. Tom has non-registered investments as well. And they have some cash and investments in their private corporation, TG Inc. As you can imagine, there could be many permutations and combinations for drawing down from these various saving accounts for Tom and Gina. But what Tom and Gina really want to know is, can they afford to spend $120,000 throughout retirement each year in retirement? How long will their savings last? And if they need to spend a little bit more in any given year, can they afford to spend any more than $120,000? So really they want to know whether they will be okay in retirement. So we prepared an illustration for Tom and Gina to help them answer those three questions. So this is a snapshot of that illustration. And what you see, the three circles, the three pie charts on this slide, compare three different withdrawal strategies for Tom and Gina. Now, the optimal order of asset withdrawal for Tom and Gina would be this withdrawal strategy that not only allows them to minimize taxes they're paying during their lifetime, but also taxes their estate would end up paying when they pass away. So in other words, the order of asset withdrawal strategy that provides the highest net estate value would typically be considered the optimal order of asset withdrawal. So in Tom and Gina's case, the hybrid strategy, as you see, provides the highest net estate value at their assumed mortality, which is based on actuarial tables. So in the year they turn 92 and 90, so 92 for Tom, 90 for Gina, the hybrid withdrawal strategy provides the highest net estate value for Tom and Gina. So this may be something they can consider as a way to draw down their retirement assets. So just at a high level, I won't go into details about the three different withdrawal strategies, but at a high level, registered deferral strategy is a withdrawal strategy that defers taxable registered money withdrawals as much as possible. Registered drawdown strategy takes that taxable RRSP and RRIF income earlier in retirement. And the hybrid strategy, you could think of it as the middle ground or the hybrid option between these two extreme strategies, which primarily focuses on taking non-registered money first.
Right. If I could just make a comment there
as well, but at a high level.
Vivek, I just want to make a comment here. These are done to the estimated mortality age. And that means there's a 50% chance people live longer. So the way we do, and the way I always recommend people, we want to plan, I would always plan these out to at least age 100. Now, I know people are saying, oh, I'm not going to last till age 100, but quite honestly, you don't know. And otherwise, again, I don't use generally mortality age because there's a 50% chance you're wrong. So again, not the strategies that Vivek is talking about here are all very valid. I would just use it to age 100 in doing my calculations.
Yeah, that's a good point. And these illustrations do go to 10 years past their assumed mortality. So what you don't see here is
that. Okay.
Yeah,
right.
So what you don't see here is the illustration would go up to age 102 and 100 for Tom and Gina. So one key point I want to highlight here is when comparing the three withdrawal strategies, if you compare the hybrid withdrawal strategy to the registered deferral strategy, the difference is just above $150,000. So what that means is Tom and Gina can save above $150,000 or just above $150,000 in taxes by optimizing their order of asset withdrawal in retirement. So it's $150,000 less that they're paying to CRA and $150,000 more that they could spend in retirement or leave extra money they could leave for their beneficiaries. Through this illustration, again, We can also show that Tom and Gina can also potentially spend up to $148,000 in retirement. And this would, again, take them to ages 102 and 100, and they could still afford to spend up to $148,000 until that year, based on the assumptions that we use for this illustration. And this is the last chart I want to share here, which shows their gross income breakdown for each year of retirement under the hybrid withdrawal strategy. So as you see, there's different components of their income each year. It's not a linear withdrawal from any given account. They do have different types of income throughout their retirement, and that's part of the complexity that Paul can help you deal with in terms of helping you optimize the order of asset withdrawal that would be most tax efficient for your specific situation.
Okay, all right. We're getting close to the end of the presentation. We want to allow a bit of time for question and answer here. Just I want to mention to everyone again, everyone who registered is going to get an email in the next few days that's going to have a link if they want to watch the replay of this entire presentation, or if they want to send that on to colleagues, friends, family members who might be interested in this. Also, we've got, if you wanted to ask us at West End Wealth, the West End Wealth Planning team, questions directly, you can send us an email at info@westendwealth.com, info@westendwealth.com. We'll be happy to get back to you, set up a quick time we can chat. And what else here? Let's go. We got a couple questions here. First one we have, let's get as many through as we can. I am an incorporated MD. I have been told by my financial planner not to bother to use a TFSA as an investment vehicle because of the advantages of investing in the corporation. I maxed out myself and my wife's RSP contributions and invest $4,000 per month in my corporation. I have 3 whole life policies, $1 million each, and I'll be funding them until age 60. Boy, a lot of information here. Vivek, I don't know whether with this information we can really give much advice here. What do you think?
Yeah, I think it's a bit too specific, would require more of an analysis rather than just a high-level answer. But so I'm surprised. I think there's always an opportunity to take advantage of TFSAs. I'm not sure.
Yeah, I'm not sure if that's correct or if I would recommend that myself. By the way, again, one of the interesting things about planning is that it's not just the numbers. You can have 2 separate situations where, let's say, 2 couples, and they're in the exact same financial situation, exact. But the strategies for one may be different than the other, the best one, because they have different backgrounds, different attitudes towards money. They have a different history. That's where the planning and the conversation has to come in to build the best strategy for someone in your situation. Let's say, here's another one here. What happens if to your CPP contributions if you pass away after a few years of retirement? Well, I think there's what, $2,500 that's left over at the end of the day.
There's a death benefit. If you have a spouse, they can also apply for a what is it called? Like they could receive part of that CPP as well. They could apply for a survivor pension benefit. So it really depends on the facts in that situation, but there could be something for your spouse that may be left.
Does that only go up to age 65, or does that continue past 65, Vivek?
It continues past 65
okay.
as well.
All right.
Yeah.
Okay. Let's see. What else do we got here? Trying to get through these is we've only got a CPP splitting. As you mentioned, this can be done when the spouse turns 60. What happens when the spouse takes their own CPP? Does that limit the total amount both spouses get?
Yeah, so it would look at the total CPP both spouses are getting and share it among both spouses. So it would look at both spouses' CPP entitlements.
Okay. Here's another one here. If one takes old age security at age 65, one can stop payments after, say, a year. That would be relevant if one starts working again at age 66 and so wants to avoid old age security clawback. And I think that's possible. You can stop your payments after that. Am I correct? I know you can at CPP. I believe you can at Old Age Security.
I
Or
believe
is
if
there
you,
a time limit on that now? Or is there a time limit, Vivek?
I believe you could stop it within 6 months, and you have to pay back if you don't want to take it. If you change your mind, you don't want to take it at 65. I'm not sure if that's what the question is getting at. You could stop it within 6 months, but you have to pay back what you received.
Okay. I thought it was a year, but I could be wrong on that one, where you can stop the payments once you've started. But yeah, I don't think you just stop and start whenever you want. Unlike, say, if you have RRIF income, you start a RRIF at age 65. 2 years later, you go back to work. Hey, I don't need this RRIF income. Well, then you can transfer that RRIF back to an RSP until you're age 71. So the opportunity exists there, but less so with with CPP and old age security. We're getting near the end of the day. I have a few clients who have asked questions there. I'll try to get back to you guys personally. Sorry I couldn't get to you now. Want to again mention an email is going out to everyone with a link for the presentation. You can watch again, send to your friends, family, colleagues that might be interested. Again, if you have a question, any of the listeners there who want to speak with us at our West End Wealth Planning team, you want to have a quick chat with us, just send us an email at info@westendwealth.com. That's info@westendwealth.com. Those of you who are interested, we have a podcast we do every couple of weeks called Retirement Straight Talk with Paul and William. William Barreca is my certified financial planning associate, and we do this. If you want to be on the list and you're not, again, send an email to info@westendwealth.com. I want to thank very much Vivek, who's taken his time to be with us here today. We had some time before the presentation to plan out how we wanted to do this. Thank you so much. A lot of great information there. And judging by the number of attendees and so forth, I think we have a lot of interest in this. And thank you all for joining us. For this webinar. We're planning another one in probably in April, a time and date and topic to be announced. Probably we're going to focus that on business owners. So with that, we're going to wrap it up just a couple of minutes short. Or maybe, you know what, we got a couple of minutes. Why don't we see if we can put in another presentation or another question or two here. Here is, if you retire early, age 62, and your taxable income, I'm assuming that's what it means, will be minimal. Would you recommend starting your RRIF early at 63 to take advantage and leave your other investments in place? Vivek, any thoughts on that?
I
Or does
think
it
that's a
just come
good
down to
strategy.
planning?
Yeah, it's one potential strategy to consider for sure, because then you're in a lower tax bracket. It goes back to the layering income concept we touched on during the presentation. So if you're in a low tax year, you could consider drawing down your RSP or your RRIF income in those years to take advantage of lower tax brackets and manage the minimum payments that would eventually begin after age 71.
Yeah, again, it comes down to planning. You want to make sure you deal with this early, because what you want to avoid is what I heard lots of times. I should have started planning this out 10, 15 years ago. I'd be in a better position today. It all depends on the planning. Again, two people in the exact same situation, you know what? They could have two completely different strategies that make most sense for them, different backgrounds, different values, different thoughts on money. It all comes down to the planning. So I think we're at 1:59. We're 1 minute left. So I'm going to, again, thanks Vivek for all his fantastic information, his help today. And thank all of you for joining us. If you'd like any more information, you want to contact us, info@westendwealth.com, info@westendwealth.com, one word. So thank you very much again. We're going to close out the presentation today. We'll see everyone soon. Take care now. Bye-bye.
Thank you, everyone.